I call the meeting to order. The first item is the roll call.
Roll call, Landon Moore,
Present.
Danny Covey,
Present.
Mark Gardner, Joel Hawkins,
Present.
David Holly.
Here.
Karen Savage, and Stephanie.
Present.
Derek.
Here.
Mimi.
Here.
Dimitri.
Here.
And myself, and Mr. Battle, not here. And did I miss anybody? Very good. We have a quorum. I think 1, 2, 3,
We do.
4. We don't, do we?
We don't.
1, 2, 3, 4.
How many do we need?
4.
Yeah, we've got.
Thank you.
Okay. Next item is the minutes from the last meeting on May 13th. Does anyone have any comments or questions?
I do have a,
Sorry, August 12th.
I have a question.
Oh, did I put
The
it
last
there?
meeting we had, we didn't have a virtual meeting, we had
We had a live meeting.
a live meeting. So that needs to be changed and call to order. Item number 1.
Okay. I will amend that.
Good catch.
Very good.
Other than that, I'm good with it.
Thank you.
And I move that we approve as changed.
Everyone agree to accept the minutes?
As amended.
All right. Okay, Ms. Phillips, can you take us through the Opeb review?
Yes, Opeb, you may not have had a chance to look through all the material, but our Opeb account held at VML Vaco for our retiree healthcare has now got $6,690,358. And if you go through it, you'll see all the securities being held on behalf of Portsmouth, who's in portfolio 1, which is the slightly more aggressive. So that's why we've got such a good return.
Patty, do we have copies of that?
You should have had it in there, but I can send that out to
No,
you.
it was on the email.
Should have been.
Yeah.
You may not have printed
It's not-
out. I would not have printed out because it was a lot of pages.
Okay.
Yeah. And if there's any questions at any time, of course, don't hesitate to ask.
Is it still the, we've put in 5 million, is that correct?
The original was the roughly 5, yeah, 4,985,000, I believe.
And do you, are they having their annual meeting this year?
I have not heard, but they usually do. I don't know if they're doing, I can inquire.
Maybe they skipped it this year. I thought it was in September.
Might have been.
Yeah, I think you're right. I think it's generally in September or October. So it would have probably already passed. They had.
I'll find out.
Yeah, if they prepared like an annual report or something like that, it'd be good to see.
Yeah, I was thinking that the annual report could probably be more helpful than anything.
I could reach out to try to get that.
Okay, thanks. Any other questions on the OPEB trust? All right, we can move on to the review of retirements by Ms. Wright.
Good morning. November 2021 retirement board meeting applications for retirement steps to report. Portsmouth Fire and Police Retirement System, Richard Long, firefighter, 27 years of service, normal service retirement October 1st, 2021. Annual base, $60,511. Annual base pay pension, $46,548. Total monthly benefit, $3,879. There's nothing to report on the Portsmouth retirement system. Unfortunately, we do have Several deaths to report. Mary Holly, date of death, December 31st of 2020. Life annuity. Francis Earlbeck, fire and police, date of death, July 29th, 2021. 50% joint and survivor annuity. Ernest Lewis, fire and police, date of death is August 20th, 21. 50% joint and survivor annuity. Albert Jones, fire and police, date of death, September 6th, 21. 50% joint and survivor annuity. And last, Beverly L. Elliott, fire and police, date of death, September 20th, 21. 50% joint and survivor annuity. Active participants as of November 1st. F&P is 6, and Portsmouth Supplemental is 11.
Okay. With that, I think we can turn it over to John Hancock.
Great. Good morning, everyone. Nice to be with you again. As per usual, and Tom's going to bring up the slides, we're going to start with an overview of the provisions of the systems before getting into the actuarial valuation results. And feel free to stop me and ask any questions as we proceed. Great, thanks, Tom. Both systems were established in the 1950s with participation freezing under the supplemental system in 1984 and under fire and police in 1995. After those dates, any new employees entered the VRS and did not participate in the City of Portsmouth systems. Benefits are paid to members upon either retirement, disability, or death under each of the systems. And turning to the next slide, we will see that under the fire and police, members are eligible for retirement benefits after 20 years of service or at the age of 50 with at least 5 years of service. The amount of benefits is based on the average of the highest 3 consecutive years of compensation and years of service. So a member receives an annual benefit of 3% for each year times the average compensation. And that 3% applies to the first 20 years. For the next 5 years, it's 2% per year, and years earned beyond 25 are credited at 1%. If a member retires prior to the age of 65, he or she receives a $200 per month supplement that's payable up until the age of 65. And on the next slide, we'll see that the supplemental system, members are eligible for retirement at the age of 50 with at least 5 years of service. Similar benefit structure to fire and police, except that the benefits are credited at 2% per year for all years. Similarly, there's also a $200 supplement that's payable until the age of 65 if the member retires prior to 65. Any questions on the provisions? Okay. And the valuation, as you'll recall, is performed annually and develops various measures that we'll want to familiarize ourselves with. The actuarial value of assets can be thought of as a 5-year average of market values and is really intended to smooth out fluctuations in the market. Sometimes it'll be greater than the market value of assets, sometimes it'll be less. But the actual value of assets is used to determine the actuarially determined contributions instead of the market value, as it really should produce a smoother pattern of contributions. The actuarial accrued liability is the present value of benefits. So if we wanted to settle all of the benefits that are due from today until the last participant passes away, based on various assumptions, the actuarial accrued liability is the amount that would be due, you would have to pay. The unfunded actuarial accrued liability is the amount by which the liabilities exceed the actuarial value of assets. The smaller that number, the better, meaning the systems are in a stronger financial position. The funded status is just another way of looking at the assets in comparison to the liabilities, and it's the percentage of liabilities covered by the assets. The higher this measure, the better. And lastly, the actuarially determined contribution is calculated based on a specific method, and that's the amount that is advised to be contributed into the plan on an annual basis. Next slide, please, Tom. So the ADC of the actuarially determined contribution is comprised of two components. One is the normal contribution, or the present value of benefits that are accruing in a particular year. That's the value of benefits that are earned by active participants. As you'll see, because there are so few active members in the system, that component is relatively small in comparison to the next component, which is the accrued liability contribution. And that's the amortization of the unfunded liability. Again, that unfunded liability is the amount by which the liabilities exceed the assets, and we amortize that, or pay it over a 15-year period in 2021. That period declines every year. So in 2022, we'll be amortizing that amount over a 14-year period. And in layman's terms, an amortization is similar to a mortgage payment. If you had a 15-year mortgage, you're paying off that debt over 15 years. Similarly, this unfunded liability is being paid off over 15 years. Some key assumptions that go into these calculations. Maybe the most key assumption is the discount rate. We use a rate of 7.25%. Previously, and I think this goes back to 2010, it was a rate of 8%. The pension liabilities are similar to a bond in that the lower the rate, the higher the value. Rates for bonds change daily, but for our purposes, the discount rate is set equal to the expected return on assets. And that is an assumption that should be reviewed periodically based on the economic environment, the allocation of assets. And I know Brian has some thoughts, so I'm going to turn it over to Brian so he can chime in here briefly.
Great, thanks, Andre, and good morning, everyone. Yeah, as Andre talked about, this assumption, this discount rate, which is also the assumption we use for expected return, is the single most important actuarial assumption that goes in to determine the financial health of the pension system. And as Andre talked about, over the last, 10 years or so, that assumption came down for us. And that is the clear trend across the United States, where pension systems, public pension systems, have been periodically reducing their return expectations. Now, we think the current 7.25% is entirely supportable and for this coming year. In fact, if you looked at some public pension plan data that's available through an organization called the National Association of State Retirement Administrators, the average or the median expected return used across the United States is in fact 7.25. There's some other data that's available through the Retirement Center at Boston College, which suggests in the public sector that number is closer to maybe 7.15. If you looked at the Virginia retirement system, they're using 6.75. So again, there's not anything that really needs to be done here, but the clear trend is to reduce those numbers, and that will have, and it will have an impact on what the financial health of the system looks like, and will have an impact on what the actuarially determined contribution will be over time. So I just want to raise that issue. Again, nothing required. But the reality is this single assumption will change things if, in fact, we get to a point in the future where that 7.25 potentially needs to drop to 7% or potentially even below over time. So that's all I wanted to mention about that. Any questions from the board about that issue?
Brian, I just wanted to add, if you could comment, that we've enjoyed a very robust market, and we're invested in those kinds of things that are riding this crest. But at some point, you know, it's logical to think that's going to come down, and so lowering the discount rate could be more realistic when we get to, say, next year.
I think that's right. And look, the reality is what's the impact of changing the discount rate, or not even changing it? What does it really mean, and how does it come into play? And it basically determines the when the city will need to kick cash into the system. It doesn't really change the dollars that ultimately will need to come into the system. It really just determines over future years, do you put more in you know, earlier years, or do you put, you know, more in later years? So it's you know, it's an important assumption, and it has a lot of visibility, and it's just something that we need to be cognizant of. And the other reality about this assumption too is you don't necessarily want to be changing it frequently, because it's not really meant to be changed frequently. But if there is a rationale that you know, future long-term expected returns are going to be lower than they had been historically, well, then that's the time we ought to think about maybe reducing it. And again, we're not an outlier, which is important in the public sector. We're kind of, you know, right down the middle of the fairway in terms of what's being used. But I just want to caution you that the clear trend is for plans like ours to start reducing those over time.
I've got a question, probably directed to you, Patty. So we talked a little bit about mentioning it on the way up in the elevator. There are certainly politics involved with funding this pension plan. With the change in leadership, do you see that we as a board may have a problem? Because I think right now our projections are based on X number of dollars per year being contributed by the city. Would you suggest that that may be a challenge for this board moving forward?
No, I don't. I think that Mimi, as CFO, will make sure that funding happens. The challenge is going to be to make sure that everyone understands, you know, the mechanics of how this works. The system, we have people who passed away. We don't have many people working in the system, actively working, and you know, technically this system should have already been funded. So, you know, it had been delayed, but it's on a great path right now.
So you foresee no problem down the road as far as continually funding it as it has been in the past?
No problem at all. What I've been able to communicate is that anytime you see me give a presentation about the retirement system, we have to fund every person who worked for the city of Portsmouth in this retirement system to the last person is there. And so they understand the relevance and the importance of ensuring that we have dollars to cover our retirement fund. Because if you work for the city, you're expecting a pension and you work to receive that pension. So to ensure that every person receives what is due to them, they will not, I can't say never, but what I will say, they understand the value and importance of having this fund.
They be in leadership.
Okay. Council, administration, they understand the relevance of ensuring that everybody who's worked for the city receives a pension.
Thank you. Okay.
Great. So we're going to get to the financial results in a second, but we always want to take a look at the membership of the plan, since that's the crux of the financials, or at least the liability side of things. As you can see, the active membership has declined year over year. That's because membership has been frozen. We're down to single digits in the fire and police system. And membership overall, including the inactive members, is also declining because it is a closed system, declining slowly, but it is getting smaller and smaller. The bulk of the membership are receiving benefits. The vested terminated participant members are those that have left the employ of the city, but not yet commenced a benefit.
And Andre, this is as of June 30, is that correct?
Yes, that is correct, of 2021. Next slide, please, Tom. On this slide, we take a look at the assets, and I mentioned that there are two measures of assets: the market value of assets, that's what you would see if you were to open up your financial statements or your bank statements, and the actuarial value of assets, which is actually used to determine the actuarially determined contribution. On the bottom of the table, you will see the return on assets. As has been mentioned, we've really benefited from superior market performance, 29% for the fiscal year ending June 30 of 2021. Our actuarial expectation, again, is 7.25%. And what I always draw the board's attention to is the relation of the actuarial value of assets to the market value. The market value is the green bar and is $191 million as of 2021. When the market value of assets exceeds the actuarial, that means that the assets have overperformed our 7.25 expectation over the past 5 years. So even though we're going to be using the lower actuarial value for determining the contribution, it's actually a good thing that the market value exceeds it. That means all of those gains, that 29% as opposed to 7.25%, those are all going to be recognized in future years and elevate that actuarial value, and again, indicates an overperformance in comparison to our 7.25 expectation. Next slide, please, Tom. This is a history of the cash flows in the fire and police system. Shows the money coming in and the money going out. Starting with the, I guess you'll call it the light green bar, those are the contributions made into the system every year, and that's always going to be positive or below the line. On the other end of the spectrum, we have the benefit payments and expenses represented by the blue bar, always going to be negative because that's assets that are coming out of the system. And then the one item that could be positive or negative are, well, I guess there's two items, but starting with the investment return, represented by the green bar. The past few years, that's been positive, actually the last 5 years. And obviously in the fiscal year ending June 30, 2021, it's been a significant amount to the tune of $44 million. The net cash flows, whether or not the asset value has increased or decreased, is represented by the transparent red bar. In just about every year that I've worked with the city, and that's going back to 2009, the net cash flows have been negative. And that's not an indication of poor investment performance. It's really a function of the benefit payments being so large in comparison to the plan itself. And the fact that the net cash flows are positive is really an indication of strong investment performance. And the fact that they're this positive this year really shines a light on how robust the investment performance and the asset returns were. Any thoughts?
Andre, maybe just to Maybe just a quick comment from me, because that's a really important point about the benefit payments as a percentage of the total system. On a prior slide, you showed the market value of assets somewhere in the $191 million range. And if we're paying out about $22 million a year in benefit payments, that's over 10% of the system on an annual basis that needs to be, in order to be cash flow positive, the assets need to return at least 10% to be able to break even. Now, I know there's contributions in there, but still, that's a big number that needs to be overcome. And to your point, that's why the cash flow position tends to be negative on an annual basis.
That's exactly right. And while it's closer to 10% this year, in prior years, it was more like 15%, which meant the investment performance and contributions had to work even harder to get to that break-even point, which was not typical in the past. Great. On the next slide, we look at a comparison of the assets and the liabilities, as well as the funded status. And because the assets have improved over the last few years, that funded status, the percentage of liabilities that are covered by the assets, has improved. We're up to 74%. And on the next slide, we take another look at the funded status, as well as the unfunded liability. The unfunded liability, again, is the dollar amount of how the assets relate to the liabilities. And you can see that the unfunded has decreased from $77 million to $58 million over the 2-year period. This is reflecting the actuarial value of assets that has the gains that we've achieved in 2021 that are deferred. If we were to reflect the market value of assets, that $58 million unfunded liability would be $35 million, and the funded status would go from 74% to 84%. So that means the actuarial value will be trending upwards, all things being equal, and the strength of the plan, the financial strength of the plan, has really improved over the years, and most importantly, this past year, because of the strong investment performance. And where does that bring us in terms of the actuarially determined contribution? 2 components. Again, the normal contribution, the value of benefits being accrued in the year, that's very small in relation to the overall contribution requirement, $127,000. But the accrued liability contribution, which is really driven by the unfunded liability, has decreased over years and decreased by $1 million this year. So the overall ADC has decreased from $7.2 million to $6.2 million from 2020 to 2021. Thoughts or questions here before we move to the supplemental system, where we'll see a similar story? Similarly, the membership in the system, because it's closed, is declining. Only 12 active members, as of June 30, 2021. And on the next slide, Tom, please, we'll see that the asset values have increased, and again, the market value exceeds the actuarial value of assets. Similar 29% investment return over the recent fiscal year. So a similar story in terms of asset performance to the fire and police system. And on the next slide, we will see a positive net cash flow in 2021 as compared to the previous years, on the back of the really strong investment performance. I will note that while the benefit payments are also significant in this plan, in previous years, they've also been closer to 15% this year, while the amount of benefit payments being paid in the fire and police plan in relation to the overall assets were closer to 10%. So still pretty significant outflows from the plan, and the net positive cash flow is a really strong indication of how well the plan performed. Next slide, please, Tom. A consistent trend of the funded status improving. We've gone from 71% to 78% funded status from 2019 to 2021. Here, we also are seeing a more significant decline in the liabilities. We would expect the liabilities to decline as the benefit payments are coming out of both the assets and liabilities, but we saw some mortality gain, meaning that more participants passed away and are no longer due a benefit than we anticipated based on our assumptions. So we saw a overperformance in terms of the liabilities as well as assets in 2021. And the dollar amount, the unfunded liability, has declined from $22 million to $15 million from 2019 to 2021. Again, if we were to reflect the market value of assets, that unfunded liability would go to $7.6 million. The funded status would improve to 89%. So again, that's the trend. All things being equal, that's what we would be looking towards. And on the next slide, we have the actuarially determined contribution for the supplemental system. That has also declined year over year. We're down to $1.6 million in contributions that are recommended for the upcoming fiscal year, from $2.2 million in 2019. And here we thought it would be beneficial for the board to see how the overall system, this combines the fire and police and the supplemental systems, have trended over the past 3 years. So the unfunded liability in combination was $99 million in 2019. We've shaved off just over $16 million in unfunded liability over a 2-year period. The funded status is improved from 69% to 75%. But again, this reflects that actuarial value of assets. If we reflected the true value, the market value, the unfunded liability drops to $42 million. The funded status improves to 85%. So that's where we are today. On the next couple of pages, we prepared a projection of where things might be in the future. And I always caution folks when reviewing projections that both assets and liabilities in the future are sensitive to not only assumptions, but economic performance. But if both the assets and liabilities perform in line with our assumptions year over year, this gives you a sense of what the economics of the plans might be. So you see the dark blue line trending upwards. That's the funded percentage, starting at 74% this year, and this is for the fire and police. The reason it's trending up is because that we show the actuarial value of assets getting closer to the market value. Right now, the actuarial value of assets is about $160 million. The market value is $190 million. So we need to recognize those gains, and that's going to drive the actuarial value of assets up higher than the 7.25% return. So that's really driving the improvement in the funded status. What do we anticipate the contributions to do? We think they're, all things being equal, within the next 5 years, the contribution will drop by about 50%, from $6.2 million to $3.2 million, and then remain relatively level over the next 5 years after that. Benefit payments are also expected to decline as the retiree base drops. Not at a precipitous level, but as the population declines, the benefit payments should decline as well. Thoughts or questions on this long-term view for the fire and police system?
I just have one quick question. Why does the contribution start going up slightly in the later years?
That is primarily a function of the actuarial cost method, the method we use to determine the contribution. And as you recall, the amortization of that unfunded, the period is declining year over year. So in those later years, that period is very low, and the funding of those unfunded liabilities is being accelerated. So that's what's driving the higher contribution. That actuarial component, or the actuarial unfunded liability, is being amortized at a faster rate in those every year, but the acceleration is greater in those years, in those later years.
That makes sense.
Yeah.
And, you know, it's not something that we need to deal with today, and it's not even as urgent as discussions around the rate of return, but that is something we're going to want to address in the next, say, 4 to 5 years. The methodology has that amortization period dropping to a single year, meaning that the unfunded liability would need to be, that amount would need to be contributed every year. And as you can imagine, we're going to have some volatility both on the liability and asset side, which could cause a very volatile contribution pattern. So we may want to put a floor on that amortization period of, say, 5 years, so that the contribution pattern is more smooth and more known to not only the board, but the city, so that you can better budget for those contributions. Right now, it shows a very smooth pattern because everything's based on our assumptions, but you don't want to be in a position where the contributions could be $1 million one year and $5 million the next year. So nothing to do right now, but something that we will monitor and address in future years.
When you get to those later years, does it make sense to sort of change the I guess it makes sense to change the formula, or the if you will, to take out that sort of volatility of the last few years?
Yeah, that's exactly what I was saying, Landon, that instead of having the unfunded liability be amortized or not amortized, need to be funded immediately, we'd want to have some floor on that amortization period, so you remove that volatility.
The other thing that could potentially come into play here as we get into future years and the liability declines and the funded status improves, it begs the question, do you need to take as much risk from an investment perspective, which then of course impacts the expected return, which then of course impacts the value of the liability. So there's this sort of circular logic that as the health of the pension system improves, maybe we can pull back on our equity exposure, but then you reduce the expected return in the discount rate, and then all of a sudden the liabilities go up and it doesn't look as good again. So there's a lot that goes into this, and over time, I think it makes sense as things improve to maybe, pull back on some of our exposure, based on what's going on in the world at a particular point in time. But none of that is potentially getting a bit less aggressive over time, is not factored into any of these projections.
Just, if you would, remind me what the amortization period is at this point. Where are we?
It's 15 years in 2021. So 15 years ago, it was reset or started 15 years ago at 30 years. And it declines by 1 year every year.
So, there could be, a policy decision perhaps to shorten that period, given that we don't have hardly anybody working in the system anymore, but just a thought that we can discuss over the next year.
Accelerate the contributions?
Accelerate the amortization of the unfunded liability. Just as a thought, because, in the past, nobody shortened the amortization period. It was always just 30 years. Is that right, Andre? I know VRS, every year it was 30 years.
That is right, but with a closed system where you have no active or fewer active participants, where contributions are being generated for those participants, it is common to see an amortization period that's either shorter or declining every year.
Thank you. I think this slide where you've combined kind of puts in perspective where we are. I'm trying to find my slide now. I've already lost it.
Slide 22, I believe you're referring to.
Where we've combined the systems now. Last year we're 70% funded, a blended rate, right? Blended between the two systems, and now we are 75% funded. So that's very positive.
Agree. Again, the investment performance has done the lion's share of the work here.
Yes, which, we can't count on the future, can we?
But I think one of the other things that had a big impact too is the extra contributions that the city made from the bond refinancing too. So those were more dollars that we didn't expect coming into the system that were able to participate in those higher returns. So that made a big impact too.
Yes, it did. Yeah.
So that brings me to the close of my prepared remarks. Any questions before turning it over to Brian? Okay. The floor is yours, Brian.
Thanks, Andre.
Thank you.
Thank you.
Excellent.
Andre, maybe you should have went second so we could end on a high note. But the actuarial results are terrific. It doesn't hurt when, we ended the measurement period in June, which was a bit better of a quarter that we're going to talk about here in the third quarter of 2021. But I guess before I do that, good morning, everyone. Jim and I apologize for not being there in person. We did have a scheduling conflict develop, but we look forward to seeing everybody again. Hopefully, I guess in February it would be. So good morning, and it's good to be with you virtually. And again, we hope to see you all in person real soon. I'm going to talk about just do a quick recap of the capital market, major capital market returns in the third quarter of 2021. I'll give you a quick update on the month of October. Jim talk a little bit about outlook, and then we'll get into the portfolio and certainly answer any questions that you might have. Tom, can you just go to slide 2 real quick? One more. One more slide forward, Tom. What? One more. It should be a table. There we go. Hopefully you can see it better on your screen than I can see on my screen here. But here are the returns of the major capital markets, first on the equity side across the globe. Below that, we look at some fixed income indices, and then below that, some alternatives, and then finally cash. The first column there is the 3-month return that we show for each of the major asset classes. So that coinciding with the third quarter, ending September 30th, and then the year-to-date period, so for the first 9 months of the year. So quickly, the second row down, we show the U.S. equity markets returns as represented by the S&P 500 index, so an index of large cap stocks. Notched its 6th consecutive quarter of positive returns. Now it's slightly positive at just over 0.5%, and a clear slowdown to what we saw in the second quarter, where the S&P was up over 8.5%, but positive nonetheless. That puts us up almost 16% for the first 9 months of the year. Yeah, I think we saw a slowdown in the third quarter for a couple of reasons. And the quarter was shaping up to be another pretty good one, and then September hit, where from the peak the market declined about 5%. So we had a pretty negative month in the month of September, which brought the S&P 500 index down and only up about 0.5% for the third quarter. So what was going on in September was a couple of things. Number one, interest rates started to tick up. They've been relatively stable. Now they've been over the last several months. The trend in interest rates has clearly been higher, as everybody believes that the underlying economy is growing at a nice clip. We're starting to see inflation rear its ugly head. There's a big debate going on whether that inflation is temporary or is maybe more structural in nature. We can certainly talk about those issues. But in September, we saw interest rates start to tick up. Outside of the inflationary side, which, again, is the big debate about whether it's temporary or maybe a little bit more sticky, you had the market starting to realize that the Fed at some point was going to start its tapering of bond purchases in the intermediate section of the fixed income market. In fact, yesterday, the Fed came out and said they are in fact going to do that. But because of that focus in September is why we saw markets decline by about maybe a little more than 5% or so. This issue of inflation is something that is really front and center with the market as well. In fact, the market's expectation for inflation in the future has reached the highest point that it's been in over 10 years. Now, there's a couple of things driving the inflation rate. Number one is the well-documented supply chain issues that we've all heard about and seen about in the press, where the ports are backed up. There's containers that can't be unloaded. There's a shortage of truck drivers. Those things, in our view, are temporary. Those issues will get resolved over time. The one issue that we're starting to see that maybe could potentially result in inflation being a little more sticky than maybe the market expects is there are starting to be some gains on the wage side. As we all have seen, it's really hard for small businesses and companies to hire workers, and they're having to pay incentives to get people to come back to work. When you have wage gains, those typically don't get pulled back over time when the economy gets to a more normal, kind of situation, when we get beyond some of the healthcare and some of these other things that we're dealing with right now. So that's the big debate that's going on. Is it temporary? Is it maybe a little bit more sticky? And I think there's some things that would suggest that maybe it's temporary. The supply chain issue will get resolved. On the flip side, you've got starting to see some wage growth that maybe is a little bit more challenging to pull back from. So we'll see how that plays out, but that's sort of the internal debate that's going on now. In terms of what
worked during the quarter. It was stuff that has been working a lot so far this year, and it's things like financial stocks and utility companies, communication services, those more value kinds of sectors of the economy. And the things that didn't work so well in the quarter were things like industrial companies, material and energy stocks. But again, a positive quarter, great. 6 consecutive quarter of positive returns, 16% for the year so far. And we'll talk again a little bit about October as well. Now, the S&P 500 is just an index of large capitalization stocks. If you looked at small cap stocks in the U.S., they lagged significantly. They're down about 4%. The Russell 2000 index was down about 4% in the quarter. And small cap stocks, the reason why those did worse than large cap stocks was this focus on higher interest rates and potentially higher inflation. There's a lot less pricing power of companies the smaller you are. It's the big companies that are able to pass through their higher costs to the consumer, and that's why small cap stocks sold off in the third quarter. So again, from a U.S. perspective, strong results for the year, maybe a little bit less so for the third quarter. But again, strong underlying economy, slowing, higher inflation, higher interest rates. Those are the things that we're looking at. In terms of non-U.S. equity markets, they continue to lag. The EFA index, which isn't shown here, but is part of this MSCI All Country World ex-US index, which is the 1, 2, 3, third row from the top. That index was down 3%. If you just stripped out developed countries, places like continental Europe, the UK, Japan, Australia, those markets were down about 0.5%. But it was really the emerging markets that you can see below that, down 8% for the quarter, that dragged down non-US equity indexes. There's a lot going on in emerging markets that we'll talk a little bit about, but in general, emerging markets tend to underperform when interest rates in the US are rising, and we've certainly seen that. The other thing that's going on, particularly in China, is I'm sure you've all undoubtedly seen the government cracking down on private business, particularly those companies that have their stocks listed outside of China. And it's really going on as a result of the National Party Congress and sort of it's the way the government tries to consolidate power, to take a little bit of power away from private industry. That has had a big impact on a lot of these companies that have done particularly well and have grown to be a big part of equity markets around the globe. But the government in China is starting to crack down on those things. And that had an impact on our return. We're going to talk more about that when we talk about one of our emerging market managers. Lastly, for September on the bond side, bonds were pretty flat. You can see the investment grade fixed income markets, the Barclays US aggregate, basically flat for the year. For the quarter. For the year, down a little more than 1.5%, reflective of the fact that interest rates have been rising this year, really coming out of the depths of the pandemic over 12 months ago. Let me just touch on October, because as sort of bad as September was, October was as good and even better than the declines we saw in September. Again, from the peak, the S&P was off about 5%, a little bit more than 5%. The S&P rallied 7% in the month of October, so we've more than made up in October for the losses that were sustained in the month of September. Small cap stocks were up about 4%. Non-US markets, the EFA index was up about between 2 and 3%. Emerging markets even eked out a small 1% gain. We estimate for the month of October, our portfolio here is going to be up about 3.5%. So and that's going to put us up about 11.5% for the calendar year to date through October. So that's all I had to say on the major capital markets. Happy to answer any questions the board may have, or we can certainly turn it over to Jim to review some of the outlook before we get into the portfolio. Okay.
Great, thanks, Brian. Hello, everybody. Great to be with you this morning. Our theme on the market really hasn't changed all that much since we last spoke, but I will I'll review a couple slides that I think are important. I think it's also important to highlight that this concern about inflation, the Fed being behind the curve, none of that was shared yesterday by the Federal Reserve. They do not believe that they are behind the curve. They're not concerned about wage inflation. They made that quite clear in their comments yesterday. So still a raging debate between the Fed and economists, but the Fed gave us their views yesterday without any doubt. I'm going to move ahead a couple slides. Andre, I'm sorry, Tom. I think we've got economic slides. There we go. Back one, please. There we go. So here we're looking at really the big four M2 growth, and we're looking at the change in money supply. And the one theme that we've been talking about now for a couple quarters is the rate of change really matters at the mid-cycle, and that's where we believe we are. And we're starting to see a number of changes occur, and these next few charts I think will highlight that. So M1, of course, is money that's in the public hand. M2 includes everything that's not exactly cash, like money market funds. So it's really a great indication of the liquidity of the system. And you can see it's been tracking this trend line for some time. But what we focus on is this rate of change at the bottom. And the Fed did make the statement yesterday that they were going to start to taper, and that means just buying fewer assets in the marketplace, mortgage-backed securities in particular, U.S. Treasuries. But even before that announcement, you could see at the bottom of this chart, the year-over-year change started to roll over. And we've also started to see countries like South Korea, Poland, Norway already start to raise interest rates. And so the next couple charts will coincide with this rate of change in M2. So let's look at some of those charts for a minute. So this next slide, we're really looking at speculative asset classes, expensive asset classes. We're looking at unprofitable tech companies, healthcare innovation, China internet companies, all high alpha asset classes. And you can see they peaked at the top of the money supply growth. And that's a clear sign that investors understand this prior chart. They're anticipating, and almost all of these have corrected very substantially. Now, Bitcoin would be considered perhaps a speculative asset that has recovered, but for the most part, this correction has timed almost perfectly with the rate of change in the money supply and the Fed balance sheet that you can see at the bottom. Next slide shows early cycle stocks, small cap stocks have also anticipated this rate of change in the money supply. So what we're looking at here is when that line is going up, early cycle stocks, early cycle sectors, autos, home builders, semiconductors, et cetera, doing very, very well. And then you can see again in March started to roll over with that peak rate of change in both growth and inflation. Next slide gets a lot of press. Brian touched on this. Bottlenecks in the economy, supply chain problems. And here we're looking at the semiconductors. And so we're looking at the Taiwan Semiconductor Index, and because most of the semiconductors come out of Taiwan, and they're really the building block of so many things, semiconductors, right? We see them in of course, in PCs, and, but also things like washing machines and lawnmowers, really driving certain parts of our economy. And you can see here that some of you may recall, the Y2K pulled forward demand. There was concern in the late 90s about moving into the next decade, drew it forward. You can see the spike, and then things started to normalize. So we see the sort of same thing. We see the spike pulled forward, lots of work from home, lots of demand for chips, lots of consumption pulled forward that we'll talk about in just a few minutes. So we think this shortage will reverse. And ultimately, what we have here is a shortage that, in our view, will not only reverse, but will likely become a glut at some point. So we're not terribly concerned about it in the long term. Next slide is auto and auto parts. And you can see we had a pretty precipitous drop right at the start of the pandemic. But that drop has recovered, and now we're up over 28% or so from the 24-month pre-COVID change. And again, we think that's a pull forward in demand, and that will reverse back to trend line over time. Next slide is interesting. It's building products and garden supplies. Never even saw a dip during the pandemic, and spiked about the same amount, about 25%. So we probably all have more garden supplies than we need in our backyard at the moment. But again, we think that this trend will reverse as well. This is a clear example, no dip, pull forward demand. And the next slide is personal income. And personal income, of course, drives retail sales. So we've had 3 spikes in personal income, retail sales, and these coincide very tightly with the 3 stimulus packages that came out of Washington. So unless there's another stimulus package, it seems pretty unlikely to us that personal income will move up and continue to support retail sales. Last slide I'll look at is consumer confidence. This is a newer slide for us. I'm still sort of studying the implications of it, but this is a slide that is a survey mostly about how consumers feel about the economy and personal finance, business conditions, et cetera. And you can see there's been almost a collapse to now we're at the point of the depths of the pandemic. So we're quite focused on this. We're studying it very closely. Some concerns are certainly drawn towards what's coming out of Washington. We've got packages that are moving forward, like infrastructure, for example, and then it's not. Build Back Better, moving forward, not moving forward. So I think that's in part causing some consternation. We can talk about this at another meeting, but the period of the Great Resignation and why people are changing jobs at such a rapid pace. We've done quite a bit of research on that. And when you leave your job, are you going to be concerned that you're going to find a job if the economy starts to slow, which it did last quarter? Interest rates moved up a little bit, and the stimulus you were perhaps expecting coming out of Washington may or may not be happening. So all of this leads us to believe this mid-cycle correction. We still think it would not be unrealistic to see a 15 to 20% correction as a result of this pull forward in demand that we just reviewed with you, and which will result in maybe some softening earnings supported by bottlenecks in the supply chain. Still, importantly, a correction in a bull market, not the beginning of a bear market. So any questions for me or for Brian? If not, we'll turn.
Yes. Can you hear me? Hear me?
Yep.
Just wondering, does this mean that we need to do a defensive step in terms of our portfolio? You kind of walk right into that, you know?
No, we're recommending we stay fully invested. We think it's very difficult to time the market. Our view is for investors who are want to capitalize on this trend. There are certain sectors and industries where you can overweight or underweight. But for this portfolio, we recommend staying the course. Now, if we did get a 15 to 20% correction, would we think about rotating into it? Yes, we would certainly think about that, taking advantage of opportunity, especially if high quality growth went on sale.
Okay.
Patty, maybe I just, oh, sorry, go ahead.
Meaning you were overweight the equity exposure 1 or 2%, which it was higher, like 5. Have you taken away the overweight?
We have, and we did that coming out of the last meeting. We were about, I want to say, closer to 4 percentage points overweight. So when we equities, when we review the portfolio, you'll see we're smack dab right on the 70% target to equities at the end of September. And as Jim mentioned in his comments, our views haven't really changed from the last time we spoke. But Patty, just to follow on to Jim's comment about, in answer to your question, I think he's absolutely right. These things are really, really hard to time correctly. And the fact of the matter is, although we review these slides and we think there's a strong basis for the views that we have and how the market is going to perform in the future, the reality is we could be wrong. And the market could absolutely continue the momentum of going and grinding higher and higher and higher, and we want to participate in that. And because of those two things, the difficulty in timing it and we could be wrong, that's why we pulled back on our overweight. That's why we got to our long-term targets, and that's a good place to be, we think, based on how we think the future is going to unfold.
So I'm assuming Brian, you'll get into it, but am I to understand that if we did have a 10 or 15% correction, we do have the cash to take advantage of that?
We do. We have some flexibility that we could increase our equity exposure to take advantage of that dip. Now, of course, nobody knows what's going to happen tomorrow, and there could be some sort of exogenous event that causes the market to go down and causes us to think of how the future is going to unfold. And so we'll just have to wait and see if this happens, when it happens, why it happens, if it makes sense to lean into it or not. But in general, based on how we're viewing the world, and if we get this normal pullback, we would probably be buyers rather than sellers.
I think it's also important to note that we're accelerating into what typically are some of the 2 best months of the year, November and December. So that's a pretty big headwind to expected 15 to 20% correction.
Okay, any other thoughts or questions about that before we get into the portfolio?
One other question. The Chinese government has put their thumb, as you indicated earlier, very hard on profitable businesses. In your opinion, and in your analyst opinion, is that a long-term or a short-term program that the Chinese government is viewing?
I think that's the right question to ask, David, and I'll answer that in a couple of ways. Number one, every 5 to 7 years, the government cracks down on various sectors of the economy. So this is really no different than what we've seen historically. What is a little different is that some of the language and the rhetoric that they're using this time around seems to be a bit more aggressive than it has been historically. Now, we don't necessarily think this is going to persist. We think it's all a function around, the timing of the National Party Congress, which is in the fall of next year. So you're likely to see, even between now and say September, October next year, some of this continue, and you're probably going to see some bounciness and volatility around that. From a long-term perspective, what the government does not want to do is they do not want to, put the pressure on their thumb too hard, where it destroys the underlying economic engine that everybody perceives as one of the greatest long-term structural opportunities, essentially, that this world has ever seen. So they're not going to do anything that's catastrophic to have a lasting impact. But yeah, we could continue to see a lot of short-term noise and more saber rattling, and maybe that's not good for certain companies or sectors, that sort of thing. I will say that they seem to be going and hitting certain sectors and companies, and then they move on to somebody else. So maybe the ones that have been hit are kind of past that storm, and maybe the ones that need to be concerned are the ones that they haven't really talked about yet. But from a long-term perspective, they're not going to do anything too severe. But from even over the next 9 months, there could be more volatility as they get closer and closer to the National Party Congress.
Okay, thank you.
But the speed and veracity of how the Chinese authorities have acted is really unprecedented. There's been over $1 trillion of value wiped out worldwide with these some of the most successful titans, entrepreneurs in China. So it's certainly something we're watching, and it all falls under this common prosperity theme that the Chinese government has, support for all people, and so they're attacking the titans and trying to redistribute some of that wealth, really taking over some of those companies.
And I think too, it's important to note that it really is centered on those companies that have their shares listed outside of China. You look at the China A-share market, which is much more kind of the domestic Chinese company that, they may sell into foreign economies, but their shares are listed in China. The China A-share market's done pretty darn well. It's these big, to Jim's point, things like Tencent and Alibaba and the companies like this, which have been, sort of a poster child of outside of China about a successful Chinese company. They just happen to have their shares listed in the United States, and that's who the government tends to be going after. So there is this, it's almost like this barbell of what's going on in China. It's the domestic companies continue to do pretty well, and their stocks are performing pretty well. But again, those outside of China are the ones that are getting, facing the brunt of the government action.
Okay. You're keeping an eye on them, right?
We are. Tom, go ahead. Let's go to, let's go ahead a couple of slides. I'm going to come back to returns in a second. One more. Sorry, one more. There we go. So here's a quick snapshot of where we stand. Both you can see on the table on the left-hand side. I mentioned earlier we're effectively right on the 70% equity target, and that's because we pulled back on equities coming out of the last meeting for a lot of the reasons we sort of reiterated. Jim reiterated here today, but that we also talked about 3 months ago. So from a broad stock bond mix, we're sitting right on top of what our long-term targets are, 70% equity exposure. Now, within equities, we have a bias towards emerging markets. And so although from an overall equity perspective, we were right on it, the fact that we were overweight emerging markets in particular and underweight U.S. markets, that hurt us a bit during the quarter. And we're going to walk through some of the attribution in a couple of minutes, but that relative positioning within equities, not an overweight to equities, but certain segments within equities impacted our return that we'll talk about in a second. So Tom, if you can go back maybe 1 or 2 slides, I think it is. Let's go right here. So here's our return. You know, based on all the things we've talked about, we show the return for the quarter, year-to-date period, and then really this custom period is when the starting point where we had discretion around hiring and firing individual managers. We had discretion about operating within the investment policy ranges and overweighting and underweighting particular asset classes. That 10/31/18 period is when that discretionary mandate started. But for the quarter, again, U.S. equity, S&P 500 was, just to refresh your memory, up about 0.5%. Small cap stocks were down 4%. Non-U.S. markets were down as well. Fixed income markets were flat. So given that, we were down about, this is all net of fees, we were down about 1%, a little bit less than 1%, 97 basis points. Our benchmark, if we were exactly on the investment policy targets of 70% equities and 22% bonds and 8% in alternatives, that benchmark would have been down about 0.7%. So we underperformed in the quarter by about 25 basis points. We'll go through some attribution to show you why that was, which is why I started my comments. We should have finished with Andre because, that's when the second quarter was so good. And, but you'll see here that we underperformed a little bit. We lost a little bit of money. Again, we made that back in October. We estimate we're up about 3.5%. So, not overly concerning to underperform by 0.25 point. For the year-to-date period, we're up about a little over 7.5%. We're up about 7.6. Our benchmark's up about 8, so we're underperforming by about 40 basis points there. Again, if we add in October, we're up about 11.5% relative, to what we see at the end of September, which was 7.6. Over the long-term period, and long-term, I would say, was when we started this discretionary mandate, we're up almost 15% per year. And that's well in excess of that benchmark of 13.5%. So about 1.3 percentage points of excess return per year. Now, a couple of other things I want to point out on this page under that custom period, if you go to the investment earnings in terms of dollars, that 14.86% translates into almost $90 million that we have in the trust fund due to the investment performance, which is just it's a mind-boggling number, but it's a lot of that is a function of the decisions that this board has made over the years. So this board should be very, very proud of the decisions that you made because they've resulted in real money and they've resulted in what Andre talked about earlier, a dramatic improvement in the funded status of the plan. We show also a since inception return going back to 2016. So before we started working with the city in this discretionary mandate, we had a non-discretionary mandate. Now, what does that mean? It means we provided advice and recommendations to the board at that time, and ultimately, it was your decision to either take those recommendations or not take those recommendations. A little bit different than the structure of the relationship today. But if we go back to that period, our return's 11.1%. The benchmark's return is 10.5%. So 60 basis points of excess return over a period of, 5.5 years. So results over the long term, really strong. Results over this year and in the quarter in particular, a little bit below. Not anything that we're concerned about, but you know, that's sort of the performance story that we see. So Tom, if you can go maybe ahead a couple of slides, we'll talk about some attribution. One more. There it is. Okay. So this is performance attribution for the quarter. And I'll walk you through this chart here. We start with the benchmark's return. So to refresh your memory, the benchmark, again, if we were exactly on our policy targets and earned broad index returns, that's representative of those asset classes, our return for the quarter would have been minus 0.72%. As we talked about from a broad stock bond mix, this broad allocation effect, this shows you the impact of being overweight or underweight the broad asset categories. And by broad asset categories, I'm talking about stocks versus bonds versus alternatives. As we talked about, we were virtually right on top of the 70% equity, 22% bond, 8% alternatives target. And you can see the impact of that because we were so close to those long-term targets was de minimis. It detracted 3 basis points of value. So for all intents and purposes, no impact whatsoever from being over or underweight broad asset categories because we weren't over or underweight any broad asset categories. What did have an impact was what I mentioned earlier, the fact that although we were at 70% equities, we were overweight emerging markets in particular. So that decision, even though we pulled back equities, we pulled back from US equities, that decision cost us 43 basis points in the quarter. Now, offsetting that 43 basis point decline was what's called selection effect. Now, what does that mean? It means we had managers that did better than their benchmark. And we'll talk about that in a second. But the active managers that we have in place, in aggregate, outperform their benchmarks. So you add all those numbers up, you get to a portfolio's return of down 93 basis points. I showed you earlier, I think it was 97 basis point decline, 97 basis points is net of fees. This number is gross of fees. But you can see all the underperformance was a function of that decision. When we pulled back on equities, we took it from US. We remain overweight emerging markets. And from a long-term perspective, we think emerging markets are going to outperform. It's just that, in the last quarter, they dramatically underperformed. And so that cost us a little bit of value. So any questions about that in terms of, how it relates to the third quarter performance before we look at a couple of managers and we'll kind of drill down into this selection effect? Okay. If you can go ahead a few slides, I'll keep going. I'll show you. Keep going. A couple more. One more. Nope, one more. One more. Keep going. Sorry. Keep going. Let's stop here. So I'm going to talk about. Actually, let's go one more slide ahead. Okay. So in terms of that selection effect, so we had active managers that in aggregate outperformed their respective benchmarks. And I'm just going to speak at a high level. We're going to talk about 2 managers as well. We combine both passive investment strategies. Now, what we mean by passive investment strategies is we have investments that are not designed to outperform the market. They're designed to give us the return that the broad market provides. So, for example, we have an S&P 500 index fund. Very low cost. Its return is going to be within a stone's throw away of what the return on the underlying S&P 500 index is. So that's what's often referred to as passive management. We have 12 active managers in our portfolio. And by active managers, we mean these folks are going out into their respective markets. They're buying individual stocks they think are going to do, or bonds that they think are going to do better than their benchmark. Of the 12 active managers we have,
8 of them outperformed in the third quarter, and 7 of them have outperformed over the year-to-date period. So from a batting average perspective, look, we just got through the World Series, so let's talk a little bit about baseball. That batting average of 8 out of 12 outperforming or 7 out of 12 outperforming is pretty good. Typically, you don't see that. You see maybe half doing outperforming and half not. But we've happened to have good managers in the portfolio that have done well over the third quarter in the year-to-date period. Again, in aggregate, they added 25 basis points, which helped offset some of the losses that came from overweighting emerging markets. Now let's talk about 2 managers. I'm not going to go through all of these. You can see it. But Tom, if you go to the prior slide, the first one I want to talk about is Rice Hall James. Now, this is a manager that's been in our portfolio for a while, and we've talked about them quite a bit. And typically, it's because they underperform. But I just want to point out that this is one of the active managers that we had in the portfolio that actually did well in the quarter and the year-to-date period. So you'll see for the third quarter, they're down. They lost money, right? The small and mid-cap segment of the market was down, but they went down substantially less than what their benchmark did. So it's never good to lose money, but anytime you could protect some capital relative to a benchmark, that's a good thing. For the year-to-date period, they're up almost 6% versus their benchmark, which is, say, closer to 2.5 or 3%. So again, favorable results from this manager. Now, why have they done well in this environment and maybe not so well in other environments? So this is a manager that invests in growth-oriented companies, so companies that are growing the revenue and earnings faster than the market. However, they have what's often referred to as a valuation framework over the top. So they're not willing to pay any price to get that growth. They want to pay a fair price for getting that growth. And just to give you a sense, there's been this rotation really coming out of the depths of the pandemic, where value-oriented companies have done better than growth-oriented companies. In fact, value stocks in the small cap space were down only 2% in the third quarter, and they're up 20% for the full year. Comparing that to growth stocks, which were down 3.5% in the quarter and up only 5% for the year-to-date period. So I'm not suggesting to you that this is a value-oriented manager, but that valuation framework means that they're not in a lot of those go-go growth stocks that had done really, really well prior to the pandemic, which is why they underperformed. And in fact, that valuation framework helped them over more recent periods. Tom, if you can go forward one slide, and this is the last manager I'll talk about. I do want to talk a little bit about one of the emerging market managers here, which, where is it? Yep. So about 3 quarters down the slide under emerging market equities, you'll see Lazard EM Core Equities. Again, we were overweight this segment of the market. This manager actually did worse than the overall market. They were down about 10% versus 8% for the benchmark. For the year-to-date period, down 6 versus down 1. And this manager squarely in the crosshairs of what's going on in China. We talked about Tencent and Alibaba. They've got about 15% of their portfolio in these 2 names. Tencent was down 20% in the third quarter. Alibaba was down 35%. That hurt. And that's why you see that underperformance relative to the benchmark. He's a good manager, a manager we've known for a long period of time. Caught up, not that these are bad companies. In fact, they're quite good companies with big, global presences. But it's this dynamic that we've talked about that's going on with the Chinese government and these kinds of companies that made it really painful to hold these kinds of names. So with that, I'm going to stop, see if there's any questions, any comments. We're happy to,
address anything you might have.
Did you change managers there? Did you used to have Artisan?
No, Artisan's on the prior slide. They're still there. Tom, if you can go back. They underperformed too, although they had a good October, so they're outperforming for the year now. But this is a manager we've had long term, and you can see, at the end of September, they're down about 3% versus the benchmark down 1%. Again, they're outperforming once you factor in October. But look at the long-term returns here. We're up almost 38% there versus a benchmark of 12%. So this is a manager we still have a lot of conviction in, a lot of confidence in, and we've done really, really well with. Over the short run, it's been a little bit more of a slug, but again, they're outperforming for the year.
How often do you change managers?
We try not to change managers ever, but because we do so much work at the outset in getting comfortable with these firms and what their competitive advantages are. We understand the environments in which they're likely to underperform and the environments in which they're likely to outperform. And we put the portfolio together in a way that uses a lot of complementary managers and exposures. So, I was a little bit facetious in saying we hope to never change a manager, but things happen. People leave, people retire, firms sell themselves to other organizations, they lose whatever a perceived competitive advantage was. And at those points, we need to make a change. I will say when we first started working with the board back in 2016, we made a lot of changes to this investment portfolio. Now we've been fortunate that those changes have really paid off because, as we talked about, we generated some really good results going back to 2016. But it really just depends on the frequency with which you need to change managers based on what's going on at a particular organization at any point in time.
Thank you.
Brian, I got a question.
Yep.
The Fed said yesterday there's a good possibility of a rate increase next year, probably last half. There's a probability of a rate increase and a possibility of 2 in the same year. What does your team feel that's going to have any major effect on the stock market in general, which then would reflect on our portfolios?
We don't. So if things go the way the market expects, we don't really expect there to be a material impact on equity prices. Now, if things changed and they caught us off guard, and instead of raising, let's just say the expectation is we're going to have 2 rate hikes in 2022. And you're right, the first one isn't going to be until the second half of the year. But let's just say inflation continues to run hot and they become overly concerned about it, and then they hike in the first quarter of next year. That would be bad for stocks. You would have an immediate reaction, typically lower. Or let's say that rate hike doesn't happen in the first quarter of next year. Let's assume that it happens as the market expects, 2 in the back half of next year, but instead of 25 basis point hikes, they're 50. That would be bad. You would have an immediate reaction of equity markets. We don't think those things are going to happen. We take the Fed at their word. It's interesting. Whenever the Fed comes out, you see this in the media. They'll put the text of the language and they'll put them side by side from one meeting to the other, and they'll highlight specific words that are different, trying to infer if the Fed's view has changed. And the reality is the Fed has telegraphed everything that they are going to do, and we try to come up with reasons to think that they're not going to do it, and yet they continue to do it. So at some point, right, we got to take the Fed at their word. Now, that's not to say they're not going to look at the data as it evolves and change their view, but they've been pretty, pretty consistent with the things they're saying and then acting on the things that they said they were going to do. And so that is good for the market. The market doesn't like uncertainty. The market doesn't like, things that it doesn't expect. And so as long as those, that dynamic continues, we should be okay. David, maybe another way to answer your question is not necessarily what the Fed is doing, but at some point there will be another recession. And at some point markets will start to price in a recession. We don't think that's, imminent by any stretch, but maybe the economic data rolls over the back half of 22, maybe early 23, where we'll start to need to think about, what the underlying strength of the economy really is.
Thank you. Appreciate it.
Any other questions?
Doing a good job. Keep it up.
Great. Thank you.
I was just going to say, before y'all leave, the next meeting is on the agenda of February 10th.
Okay.
We might have to do work on that.
The only other item that we had on the agenda, and I just wanted to mention this, and we can, vote on it next meeting, but we have an open position of vice chair. So we're looking for volunteers.
Did we elect at last meeting a vice chair?
I thought I was a vice chair.
Okay.
We did elect, so, okay.
When you were elected chair.
Because I knew that Mark.
That meeting or the meeting after.
All right, so
if you don't want me, that's okay.
So I couldn't remember if we had done it or not, and
I just need to double my pay, that's all.
Consider it done. Your pay is now double.
Okay, thanks. Do we need to get new parking passes or not? We're not worried about it.
What is the long-term plan is to.
So it'll probably be, I don't know how it was at first, because now we have very few parking, available parking in the building, but I think we can probably snatch a couple of visitor spaces before the meeting.
Yeah, I think they had passes in the, so they could put in their.
Yeah, we had it, but they're dated from.
They need
2 years
They
ago.
haven't been updated since.
So they could
COVID.
park in a regular spot, a
visitor
unreserved spot, yeah.
I guess my question is, if they're not checking meters, we don't have to worry about it, do we?
But I don't know if they are or not, so I don't want you to get a ticket
If
in
they
there
haven't been, they probably will start,
Yeah. that day.
Just take the ticket out of your pay.
Yes.
Now that
Withhold it.
now that it's double, you can afford it.
I can afford it.
But the plan is to, we're trying to get set up, either return to the city manager's conference room or finance conference room to have it set up similar to this room. So we would love to be able to continue to use this room, but this is their workforce development room and they need this room for other purposes.
Okay.
I'm happy to see this busy enough. We have to move around rooms. That's,
Things that, yeah, people, yeah.
I like that.
Yeah.
Okay, I think we can adjourn.
Motion to adjourn.
Everybody have a good holiday.
Yeah, happy Thanksgiving,
Thanks,
everyone.
everybody. Happy holidays.
Thanks,
Holiday,
everybody.
guys.
Be well.
Bye.